Hello, everybody, and thank you all for joining us. I'm Bonnie Halper. I write the weekly Startup One Stop newsletter. I'll put the link in the chat. It's that always has the helpful links and information for founders and an editorial that covers technology. And every 2 weeks, we host an online breakfast with one investor and a small self-selecting group of entrepreneurs. And we want to thank WorkChew for hosting us. Christine, tell us about WorkChew.
Good morning. WorkChew partners with hotels and restaurants across the country to provide remote workers with safe working spaces. You can book individual seats in our partner locations or meeting rooms by the hour.
Oh, thank you. If I go dark, it's because, as you see, I'm having allergy problems today, so I don't want to blow my nose on camera. And today our guest is Joe Milam from AngelSpan, and he's going to talk about the Bell-Mason Diagnostic. I don't know if you want to have everybody introduce themselves first or afterwards, and I'm sure everybody will have questions, but it's up to you, George. Tell us a little bit about your background and how you know George. Gordon. I know George Bell too. Gordon, I know Gordon too. But up to you.
Well, thank you, Bonnie. And again, it's your show, so if you want people to introduce themselves first or last, that's entirely up to you. I'm fine with it. Doesn't matter to me.
Can I skip Eric?
I would prefer that, but other than that, sure.
So Adrian, Eric, you want to briefly introduce yourself? We'll just get it over with.
Besides being the founder and the head of the Joe Milam fan club and Delicatessen, I am the CEO of Milamatch, and Milamatch has proprietary and patented technology called cognitive linguistics, and we solve the problem of employee attrition all the way from the recruiting to internally and advancement. So that's what we do.
Oh, thank you. Adriana. Oh, Adriania.
Good morning. It's Adriana.
Okay. I saw the I at the last minute. Okay.
Yeah, blame my parents. So my name is Adriana Collins. I am a Chicago entrepreneur and owner of the Adriana Company. It is a holding company with multiple divisions, currently working more on the business services. And yeah, I will have my camera on in just a little while, so you guys will see my face later.
Okay, thank you. Alicia, I'm just going down the list. Alicia, you want to introduce yourself? You're muted right now. I will go back. Go ahead.
I'm here. I apologize. I am multitasking like Adriana is this morning. Hi, my name is Alicia Overton. I am a business operations consultant in Chicago. And I was excited to see a morning chat with an investor. So this is pretty good to be able to meet everyone in the area. So I look forward to hearing what we'll be talking about this morning.
Okay, thank you. And Davina.
Good morning, everybody. I'm Davina Fettergreen. I'm CEO of Fettergreen Consulting. We basically are a full service suite. So I'm a business consultant strategist. We also help people with marketing for their business plans, pitch decks, investor decks. We also do, we help them raise capital, debt financing, etc.
Oh, thank you. And Gerald.
Hello, everyone. I'm calling from Austria.
Oh.
And as you can see, I'm a little bit younger than you. I'm a CMO from a startup from Linz here in Austria, and a young investor. And I'm currently would like to improve myself in investing. And yeah, I'm interested in what you're talking about.
Well, thank you. Kwani, I hope I'm not butchering your name. Or Queen, I don't know how to pronounce your name.
It's Quinn.
Queen, I was right.
Yeah, I'll actually answer to anything that's close enough. My name is Quinn. I am based in Guelph, Ontario, in Canada. I am a founder for a small tech startup company that is an animal-centric social media that uses machine learning for recognizing animals and for identifying it and recognizing the emotions. So right now we're conducting research, creating our own algorithm for animal recognition and emotions recognition. And the way we're doing it differently is that it's a 360 degrees head, 360 degrees body recognition instead of just a facial recognition. And I'm at a stage where now I'm starting to plan for the development of the platform. And so this is the time when I'm starting to explore funding.
Okay, thank you. Ian, another
Hi.
Canadian,
Yes.
and happy belated Canada Day to you.
Thank you. Happy 4th to you. So, so Ian Garmaze in Toronto. I am the Canadian sales and marketing rep for the Virtual Film School, Hollywood. And we teach people how to make short, monetizable videos for social platforms.
Andy.
Good morning. I'm Andy Harrison. I am a strategy consultant in the New York metro area. I pretty much the same thing that Davina does, I do, hopefully in a complementary fashion. Been doing this for way too many years, and I work with Bonnie amongst others, and it's my story and I'm sticking to it.
And Andy used to help me out at the breakfast when we used to have them in person.
Yes, that's true. I was her muscle.
Yes.
The tattoo to her Mr. Rourke, if you want an old Fantasy Island reference. But basically, yes. Yes, when we actually were able to do them in person, and hopefully this will have the same experience for you all that the in-person experience had, because I hate to use the word magic, but there was something special about it, the way people interacted and just sort of the energy and vibe that came out of it. I'm not sure if Bonnie's giving the full backstory, but people got funded as a result of meeting.
Yes, they did.
Prospective investors at the terrestrial breakfast, shall we say.
Thank you. So Alicia, I did Alicia, I'm sorry. Allie Case, I meant to say Allie Case. Oh, you're muted, Allie. I don't know if you're trying to introduce yourself, or if you're just shy. Lil always posts her information in the chat. It's difficult for because she's multitasking and she's at work. Matthew.
Yes, hello. Can you hear me?
Yes.
Yes. Oh, great. Thank you, guys. So I am Matthew Bassarico. I am an investor. I'm also the chief investment officer of a holding company that is in several strategic places. We're looking into blockchain projects, looking into solar and green energy projects, and we're also tech agnostic somewhat. I could definitely explain that a little bit more to anybody if they'd like to know. And I'm very excited right now because I'm in the midst of a 3-day meeting with a very, very wealthy family here in Los Angeles, and it's looking very good. So that is my little intro to everybody. Hope everyone's having a great day.
We are. Sean, welcome back. Introduce yourself.
Yes. Thanks for having me. Happy 4th of July. If I didn't say that before. My name's Sean. I'm a venture capital scout. I'm currently in the UK, but I'm co-located between the UK and the US. A company's called Big Win Venture Tech. We kind of operate on 2 tiers. So the first tier is spend a lot of time helping founders kind of de-risk and to access trusted capital. Also help with providing fundraising strategies. Also help them with a lot of like business operational tactics to, advance a proof of concept to MVP and commercialization and delivery to and service. So the philosophy behind that tier 1 is so the investor can land and expand basically. On the tier 2, we help investors obviously make strategic investments in founders across a range of specific verticals, mainly around tech, modeling, simulation, training, aviation, aerospace, space, defense tech, game development, infrastructure, robotics, medical, transportation. I would say our secret sauce, because I find it's the best way to kind of explain what we do, is that we work our socks off, trying to cultivate active strategic partnerships between the US, UK, and Europe across various channels. And as a consequence, I mean, I strongly believe that we're able to kind of arbitrage a lot of the value propositions a lot more kind of cleanly and effectively than most of our peers and competitors.
Okay, thank you. Oh, Allie can't speak. Allie can't introduce herself as she's on a plane. So, Joe, I'm going to turn the mic over to you, the proverbial mic.
All right. Well, Joe Milam here. I put my contact info in the LinkedIn, so I can truncate some of my background, but the real formative part of my background is I ran a multifamily office for 20 years, and I joined a firm, and I had this series of Forrest Gump-like experiences. I mean, I got lucky to land in the right place at the right time, and I did have the right skill set. I have to give myself enough credit, but it was an unbelievably fortuitous turn of events where I joined this, what was recognized and as the most boutique investment firm, think multifamily office, in the Bay Area. And it had been recently purchased by the bank in Liechtenstein. They sent a consultant out to find that firm and bought this specific firm in '88. I joined in '90. Then my boss, who was old San Francisco money, Stanford MBA, usual pedigree, he died of cancer. And I actually took over the business and bought it back from the bank in '93. And we were right there at 3000 Sand Hill. And we had a lot of central figures as clients because of who my boss was and his social circles and his history there in the Bay Area, et cetera, et cetera. So I stepped into an unbelievable client base. And I took over the firm, and then the internet commercializes and all hell breaks loose, obviously, in angel and venture investing, and happened all right under my nose. And we did our own securities analysis. I was a pretty rigorous securities analyst, and then having taken over the firm, designed a new investment, refined our research process and our portfolio management process, built a robust institutional back office of trading systems and that sort of stuff, because I have a background in computers as well. And long story short, from 96 through 09, our firm was the best performing large cap core manager in the United States based on absolute risk adjusted return. So we were literally the best at what we did. I got very active in angel investing because it happened right under my nose. The Band of Angels was founded in my office by my subtenant, Hans Severance. And I was one of the first members in that. And then I was a member of eBay Angels when they had an angel group that sprung up out of an offshoot from their venture activities. And so I just got lucky. I was in the right place at the right time with the right skill sets. And I witnessed firsthand this process of how we fund innovation from the insider's view. But I was viewing that process from the lens of a rigorous money manager. And that really informed everything I've done since in trying to bring the same level of process rigor and investment management disciplines to how we fund innovation. So, and again, and this Bell-Mason, it's very relevant to this Bell-Mason, by the way, so I will connect the dots fairly quickly. But the key point of this the difference between how we fund innovation and how we invest in the public securities is just the simple fact that, when we did our own securities research and we didn't listen to Wall Street analysts, but why was it that the managements of GE and IBM and Intel and Cisco or whatever company we were researching to buy and put their stock to put in our clients' portfolios, why didn't they have to come to my office and pitch me on their business before I decided to buy the stock and put it in our clients' portfolios? Now that kind of sounds silly, but that's how we fund innovation. We force entrepreneurs to go pitch somebody in some analog in-person process, which injects massive amounts of both inefficiencies and inaccuracies, if you will, biases and what have you. I never had to meet the managements. We could literally manage a portfolio from a laptop, only looking at data. And the software and the data vendor we used to analyze public companies allowed us to push a button in the software. So we didn't even know who the company was. We were just looking at data. So we were completely objective and as we defined our thesis. We were a large cap core and we were a GARP style. If those of you that know the investment world, it's growth at a reasonable price. So we weren't high go growth, high PE multiple growth investors. We weren't deep value turnaround special situation. We were that middle ground because we were managing old money with clients with names like DuPont and others. And these were all the social connections of my prior boss. So the the fact is that how we fund innovation is archaic, and we're now seeing finally, last fall, Sequoia very publicly announced they're changing their venture model, and in their announcement, they talked about how the old venture model is outdated. And they weren't the first to change their model. Actually, I think General Atlantic was first, and then Sequoia actually did the same thing. Then, Andreessen. Then Sequoia did their big announcement last fall, and then this week, I think it was either Monday, Tuesday, or maybe Friday, Bessemer changed their model as well for the same reasons. And they're all becoming what I used to be, RIAs, registered investment advisors, taking more of a portfolio approach to how they're investing their venture dollars. So the industry is moving the very direction which I observed firsthand 27 years ago, as I got active in angel investing. And I've been working on bringing portfolio management process and rigor to how we fund innovation. Now the industry is catching up. The key to being able to do what I did in the public markets, to be able to do that in the private markets, is making sure that you have good information coming from the startups. In fact, if you know the history of public markets, prior to 1933, we invested in public securities the same way we invested in private securities. There was no requirements for adhering to standardized accounting practices, GAAP accounting. They didn't have to disclose the way they do now with 10Ks, 10Qs. They didn't have to be as transparent as they're now required to be. That was exactly what the 33 Act, if you look at it, the Securities Act of 1933, if you look at the actual act, the legislation, in an act of risk management, because of what happened in the 20s, all the shenanigans that went on that led to the hype and then the crash of 29 and had such an outsized impact on our economy, they said, wait a second here, we got to fix how we're investing in public securities. So they established the SEC under the 33 Act to enforce these new standardized reporting requirements that publicly traded companies are enforced to adhere to, including adhering to GAAP accounting, but other periodic and standardized external reporting. So there's no information advantage by having inside information or meeting with the management or all that sort of noise, because that leads to bad behavior and bad outcomes. And then in the Investment Company Act of 1940, or the 40 Act, then literally was passed to, in a act of further risk management. The language of the 40 Act says, to further risk management, they formalize the process of the management of diversified portfolios. So a mutual fund is a 40 Act product. ETFs are 40 Act products. These are all diversified portfolios. And they establish those ground rules and those requirements of a 40 Act investment vehicle to manage risk better also through proper diversification and professional management. So that evolutionary track is now what's happening in the venture industry. But it can't get there unless we start with what the 33 Act did to begin with, which is standardized reporting coming from startups. And that is the core of what AngelSpan does. Now, that's the first thing we built. Our ability to be able to establish a standard for startups, if not, and our aspirations are to be the standard, is the Bell-Mason Diagnostic. It was built by Gordon Bell, who, if you look at his Wikipedia, it's as long as your arm. He is a rock star, and he's not a narcissist, but he's a rock star. If you look at the history of our technology world, he is a rock star. We've all heard of Moore's Law, the advancement of chip technologies. There's also Metcalfe's Law, after Bob Metcalfe. It's the exponential curve, the network effect, if you will. The power of a network is an exponential function based on each incremental node of that network that's added. So the more nodes, the more exponential power the network has. That's called Metcalfe's Law. Well, there's also a Bell's Law, but a lot of people don't know about it. Well, Gordon, he was the inventor of the mini computer when he was at Digital Equipment Corp. He taught computer science at Carnegie Mellon, put that program on its map. He's the first winner of the John Newman Award, which is sort of like the Nobel Prize for technologists. They actually established the award, and he was the first winner. They basically did it for him. This is all on his Wikipedia. After a heart attack in the early 80s, he moved out to Silicon Valley, where he lives today in San Francisco. And he became an advisor to a lot of tech companies. And he realized these were smart people doing interesting work, but they didn't know how to build a business. They were smart technologists solving really interesting problems in a thoughtful way, but they didn't know how to build a business to monetize this good idea over a sustainable period of time. He said, there's got to be a way to figure out, much like when you write software, You write lines of code that build on each other until such time as when all the code lines are written in QC and all that sort of stuff, you have a self-contained software program that functions the way you want it to. But you have to write the sequential lines of code in order because they build on each other. He says there's got to be a way to create a similar roadmap to how to build a startup. So he grabbed Heidi Mason, who was a consultant, Wharton educated, smart gal he met when he was at Digital Equipment Corp, and Coopers and Lybrand, now PwC, because they also recognize that even GAAP accounting is an insufficient construct to report the value creating milestones that take place in the earliest stages of the startup journey. You know, today, if you're spending money on lawyers to file for IP, it just shows up as a line item expense, but you're creating what's in accounting terms called an intangible asset. It's a balance sheet asset that is technically an intangible asset. If you're paying programmers to build the software, even under GAAP accounting, you're expensing that as an R&D expense to get a deduction against your payroll taxes. So in fact, the very asset you're building and paying developers to build it gets expensed in the period you write those checks. So it never shows up on your balance sheet, yet it's your key asset. So this is an example of the value creating steps that entrepreneurs go through in the earliest stages that can't be captured even under GAAP accounting. And so there needed to be a way to construct both a series of operational milestones that are the right things to do at the right time, given the stage of the company's startup lifecycle. But also, not only is it the right things to do, but because of Cooper's goal, it was also because they also created a scoring system to assign a numerical value to the accomplishment of these operational early stage milestones that may or may not ever show up on the financial statements, but they're absolutely value creating steps. And they had to be recognized in some tangible, objective way. So they also created a scoring system. So you can track over time, the value creation steps that take place where the financial statements just could never capture it properly. And that was built and architected, designed, and built by Heidi, Gordon, and Coopers and Lybrand, back tested over originally hundreds of companies. Now it's over, I think it's probably over 10,000. Heidi still uses it. You can look up the Bell-Mason Group. She uses it as a strategy consulting framework for corporate venture initiatives. They can get corporations to write big checks to hire the Bell-Mason Group to come in and design their research process, their due diligence process, and their post-investment monitoring for this corporate balance sheet asset called their venture arm. Okay. It's a process-based way to actually track the value creation steps in the early, well before the financial statements could ever reflect what's actually going on inside the company. Well, when I started the company back in 2000, it was my first attempt at bringing this sort of institutional investment process rigor to the venture asset class. I hired a CEO to run the company called Angel Legacy. It lasted 3 years. It was way too soon. And 9/11 pretty much put a stake in the heart, and I had to shut it down in 2003. Started in 2000. We got to revenue. I had a CEO to run it. I wasn't trying to be a startup guy. I was a money manager. But I was an active angel investor, and my clients wanted me to invest their money as well. And as a really anal retentive, process-oriented money manager, I couldn't invest their money well or my own. So I both halted my own angel investing and theirs and launched Angel Legacy to build the toolkit so I could manage money in the private markets the same way I manage money in the public markets, with the same level of access to data, objective data. And that's where I learned about the Bell-Mason Diagnostic, because I'd never started a company. And the book, Gordon wrote the first book on how to start a startup. It's called High Tech Ventures, The Guide to Entrepreneurial Success. So as a guy who does his research, having never started a company, I went and found the book on how to start a startup. And the first thing he said was, if you've never run a startup, go hire a CEO that has. So I did. And that's how we went about building Angel Legacy. And that's how I got to introduce myself to the Bell-Mason Diagnostic. I spoke to Heidi back then, got to know her, but I never spoke to Gordon. Fast forward, I moved to Austin 8 years ago and was encouraged to relaunch that old company, Angel Legacy, because now the timing is much better. And as evidenced by the Sequoias and the the Bessemers and recent and others, the marketplace is finally now moving in the direction which I tried to get it to move 22 years ago with my first attempt at bringing this investment process rigor to the private market investing. And when I launched AngelSpan and our legacy funds division back in well, it was 8 years ago in January, so it'd be almost 9 years, 8.5 years. I reached out to Heidi Mason again. and I got to know Gordon. And as we were building this out, I was always using the Bell-Mason structure of AngelSpan's core investor relations service, because if you don't have good standardized reporting coming from startups, you can't deploy all the other good portfolio management practices. So that's why we built AngelSpan first. And I built it around the Bell-Mason Diagnostic, but I always wanted a partnership with them. I wanted more access to the inner workings of the Bell-Mason. And fast forward in 2015, not only did we establish a licensing relationship with the Bell-Mason Group, but Gordon Bell himself invested in our company. So we have the inner workings of the Bell-Mason that structures how we do reporting, and we score them against the Bell-Mason every month. Our startup clients, Eric is one of them. He can give you a testimonial to this, but we actually score against the Bell-Mason every month. And for our clients, we create a quarterly tear sheet, which is literally a Wall Street quality analysis on how our clients are performing against this Bell-Mason Diagnostic. We've created not only the first public company-like standardized investor relations reporting, like public companies, but we also created the first Wall Street quality performance analytics on private companies, because we have inside information and the structure of the Bell-Mason to organize that inside information so that the investors can now have objective, standardized, longitudinal analysis to build portfolios of startups. Get off of this, find the hot deal, chasing the next shiny object that everybody seems to be excited about. So that's the sort of journey of where we're at. I'm happy to jump in further into the details of the Bell-Mason. There's lots of information. And Bonnie, did you send around those two pieces of those two documents I sent you this morning? Was that available to everybody?
Yes, I did. Did you want to do a screen share? I didn't send them to Christine.
Yeah, why don't you make me a co-host, and I'll bring those up and sort of walk you through some of this stuff. Okay.
Christine, can you make him a co-host so we can do a screen share?
You should be able to share your screen.
Okay, good. Thank you. Let me see. Now I've just got to navigate my own damned. Okay. Yeah, I've got it.
Sorry. As a host, you're able to make it functional that everyone is able to share their screen and a line in the back.
Yes, I forgot about that.
Yeah.
Yeah, I'm just looking for the right piece to pull up here, so forgive me. I sent them over to Bonnie this morning, but I want to make sure I pull the right one up, because this is the chapter extracted right from his book that I read about and got exposed to it originally. Excuse me here. This is the old guy fumbling around the computers, right?
Maybe I should send it to Christine and she should share it.
That might be smarter.
Seriously?
Oh, I'm just trying to find it here. I just hate wasting everybody's time. I didn't have it pulled. I thought I had the right file pulled up.
Oh, it'll be in the email that you sent me.
Yeah, that's what I'm looking for. That's what I'm looking for.
Or I can forward it to you.
I apologize, folks. Let's see here. Oh, there it is. All right, there we go. No, that's not the right one. Oh my God. Yeah, send it to me again, Bonnie. I'm sorry.
Okay, let me do that right this very second.
Yeah, I did so many emails this morning already. It's just like, oh my God, I can't find it.
You gotta serenade us, Joe.
Yeah, I was just gonna say we gotta.
Everybody has.
Oh my love. Actually, I'd rather do Elvis. Oh, I wish I was in the land of cotton. What times, Bonnie? Did you post it in the chat box? See, you're not finding it either, are you?
No, I did find it. It's not sending it's sending. I did find it immediately.
And they'll just send it back to me.
I know I am.
We need a little more action, a little less conversation here.
A little more.
Andy, you want to share it?
Hey, have you all seen the Elvis movie, by the way? Oh my God.
Is it good? Because my girlfriend wants to, well, a friend of mine wants to go with me.
Oh, it's phenomenal. I've seen it twice.
I watched a bit about his background. I mean, he worked really hard on it.
Yeah. Actually, Bonnie, the thing I sent you is not the one I wanted to pull up from the chapter. Actually, I didn't send the right one to you.
Oh, okay. Never mind then.
Yeah, I know. That's where I was struggling. I didn't actually send the right one to you. All right, I'll start with this, and forgive me here. Yeah, I'll just work from our own collateral. I'll forward that to you, Bonnie. You can send everybody afterwards the chapter.
Okay.
All right. All righty, here we go. Sorry about that. So this is the components of the Bell-Mason Diagnostic are all around these 12 dimensions of the relevant areas where a startup needs to focus their attention and hit milestones across all these 12 topics. There's 4 broad topics. Product, which has 3 areas. Can you deliver it? Can you make it? And can you protect it? The platform itself. This is a modern version, a SaaS version of the Bell-Mason. This thing goes back to the early 90s, well before SaaS. Under the market section, the subcategories are the business plan itself. What market are you going after? Then your efforts of marketing, and then your sales. Those are subcategories of the market section. Think of the 4 as 4 pillars of a business. Under people, you've got the internal leadership, CEO. You've got the internal operating team. And then you've got the external leadership, your board of directors and advisory board. Those are the subcategories under the people pillar, if you will. Under finance and operations, it's control and ops. This is accounting and legal and funding and your current cash status, right? Burn rate, if you will. So there's 12 subcategories under these 4 pillars in total. And there's granular milestones associated with these 12 subtopics at all the natural life cycle stages of a business. And there's 4 of them. Well, there's actually a 5th, but the 5th one is like, they're way baked and done. The first stage is called the concept stage. And your principal goal there is to just get something down with a couple of internal co-founders to generalize what you're looking for and do a little bit of early testing as whether there's relevancy to your idea or not. Or do you just something you want to do, but there's really nothing. So it's that early stage. The seed stage is the process of trying to do some market validation, build the MVP. And what should you do on all these topics to hit those goals for each one of those stages? So there's concept stage, seed stage. The 3rd stage used to be called product development. Now it's called the alpha stage. The 4th stage used to be called market development, but now it's called the beta stage because they kind of wanted to associate it with funding rounds. Even though even the label of funding rounds has been so diluted and non-standardized, pre-seed, seed, A, B, C, D, E. There are companies that go public in the alpha stage. The stage is not associated with funding. It's associated with how much have you built of the business. Now, another way to think of the Bell-Mason Diagnostic is think of how when you build a building from the ground up. Here in Austin, we've got cranes all over downtown and new buildings going in. And what do? They come in and buy a city block or buy a big open lot. Then they start tearing down everything else and they start digging a hole in the ground after they've obviously got permitting and their financing lined up, and they've got their business plan, which is the architectural design and rendering and all that sort of stuff. And they start literally spending money to build the building. First thing they do is they dig a hole in the ground to start putting in the infrastructure of, wait for it, plumbing, electrical, infrastructure of the skeleton, the carpentry, if you will, right? There's 4 basic areas of building a building: electrical, plumbing, carpentry, and Thursday morning. Sorry, there's a 4th. Well, there's an equivalent. It's the same thing. And as you're building a building, you do a certain amount of spending of your construction financing, and then you have to halt and have it inspected. Did you complete this phase of building the building? And it has to get inspected by an objective party before you can proceed. And then you get a next tranche of construction financing release to build the next phase. And the next phase, you don't monetize that building until everything's done, and then you get to charge rents. Well, building a business is not much different. You've got to build before you can monetize. And did you build everything properly at that respective stage of the business, just like a building? It needs to be. This is like an inspection roadmap. Now, because we've got the Bell-Mason Diagnostic and we licensed it, and we structured both our reporting services around it, we also score our clients or inspect them, if you will, every month. We literally, what they report they accomplished, and we trained our clients on what the relevant Bell-Mason construct is, but we do not tell our clients what the specific granular milestones are. We don't let them gamify this, in other words. We just tell them, you've got to report what you've tangibly accomplished within the construct of this rubric or framework. And then we will define whether you're just running in place, i.e. hitting the same milestone multiple times, or whether you're actually progressing. And we score them against the Bell-Mason for the progress of hitting the milestones across these 12 dimensions, because we have the specific milestones associated with the 4 stages across these 12 dimensions. So we score them every month. And the result is we end up creating this sort of analysis. These are the 4 stages. Concept stage. The why is defined. I was giving you some of these highlights. And these 4 colored loops are our graphic representation. The Bell-Mason group still uses it. So they use a spider graph, if you know what a spider graph looks like, to represent the progress as they're building out the business from the inside out of a spider graph. We do it in this sort of horse race around the 4 stages. Okay, we had to, and we've branded this SMART IR, and SMART stands for standardized, monitoring, analysis, reporting, and tracking. All of that is captured through our investor relations service and our scoring against the Bell-Mason. IR is investor relations. So this is our SMART IR score on this sample company. And that's a representation. This is an alpha stage company because they've hit the milestones. Think of this as like a building that's now, it's a 5-story building and they're working on their 4th story right now. They're hitting the 4th story construction milestones. All right. It's not hard to know that you couldn't be working on the 4th story unless the 1st, 2nd, 3rd were already completed, because the very actions themselves speak to what you've already accomplished. We do the same thing in scoring our client. They can come to us and hire AngelSpan, and it's a common question we get. How do you look backwards on what they've accomplished? So we don't have to go back, look backwards, because when they tell us what they're working on now, we know within the construct of the Bell-Mason, they couldn't be accomplishing that milestone unless they've hit these prior ones. Just like, again, the example of the 4th floor, meaning you have to have built the first 3 first. Okay. But it's all within this construct. So in this case, this is a company that is really building this business really, really well. What you don't want to see is that proverbial product market fit, where you see this blue, this light blue is the product milestones. And you can see these product milestones way ahead, and then a lot of these other areas way behind, including their market milestones. And so we have an objective way to see whether they're actually looking for and finding product market fit. In fact, the lean startup canvas itself was lifted out of the Bell-Mason Diagnostic just around these product market milestones in the seed and alpha stage. Steve Blank, who teaches the lean startup at Stanford and who's popularized it, he actually is credited in Gordon's book. You can go look it up. That's where he got the lean startup canvas milestones, all around addressing the operational milestones around finding product market fit. We just capture everything across all stages because of our licensing and our access to the inner workings of Bell-Mason. I'm going to stop there because I know I've covered a boatload and there's got to be some questions. And I'll talk about the importance of what I just represented for both startups and investors, or maybe I can have Eric speak to it because he's been a good client a long time and he's seen his audience's reaction to this level of information and insight on Milam. So.
Does anybody have a question? Feel free to ask.
Well, yeah, I have a question.
Yes, sir.
Yeah, so what kind of testing have you done to assess the performance of this model? Like, have you gone back and looked at, companies that were launched a few years ago and whether or not they would have, how they did on these metrics and whether or not they were successful?
That's a great question, and it's one I get all the time. And if you think about the absence of knowledge about the Bell-Mason amongst most startups and most VCs, there's no way of doing that.
Oh.
I can go back test, I ran a hedge fund, a long short hedge fund when I was managing money for our clients. It's easy to build algorithmic quant models because you do have data, historical data, price data, and financial data to associate price movements with the financial data. There's no way to do that with. That's not a possible. It's a logical question. What Gordon and Heidi and Coopers did do, though, is in tracking these hundreds and hundreds of companies originally in the scoring, they found that companies that had reached, I think it was 75 Bell-Mason points, their own calibration scoring system, had a 94% chance of a positive outcome. That's there's a great deck on the internet. You can go, if you just Google search Bell-Mason Diagnostic, it's about in fact, let me pull it up for you all, because this is really fun to see. I'm going to stop the screen share so you're not watching me navigate the internet here. This is really a charming deck because it's the original deck. And you can see it's like in the original version of PowerPoint too. It's really a crude presentation deck. And it's really kind of charming because it's almost like a period piece, if you will, a snapshot of the way stuff used to be communicated. All righty, hang on a second. Oh, no, that's not the right link. Oh, damn it. This might be it. No, I'm really sorry, Bonnie. I'm sorry I'm not more better prepared for this. I should have had this all queued up at one time.
Let me see if I have it.
Wonderful presentation on this. Yeah, here it is. I found it. All right. And I will send this in the Bonnie to you and for you to send to everybody afterwards. And again, I apologize. I don't want to waste you guys' time. Sorry, I didn't have this queued up better. But it walks through this scoring. He gives a lot of case studies on specific companies scoring and the outcomes of venture funded companies. It's a wonderful case study. Oh, is this? I think that is it, Bonnie. Ah, you found it. Thank you.
I did find it. Yeah.
You did find it. So I'm going to screen share that sucker now. Thank you, Bonnie. Can y'all see this?
Yeah.
So this was from 2000. And again, it's sort of the meat of the book, High Tech Ventures, A Guide to Entrepreneurial Success, right? Came out in 91. Think about that. The first book on how to start a startup with this level of scientific rigor Gordon wrote. This is, again, I would encourage you all to go find this. It's in the chat box now, so it can speak to exactly these this is the outcome. This is the value proposition for both the startup and investors if they had access to a Bell-Mason score on the companies they were evaluating. It does allow you to calibrate risk, both operational risk, where there are gaps in what they're building. It's like a building. If they built one side of the building before they started the other side of the building, that's not a very good contractor, right? You want to build everything in sequence from the ground up, not one side of it and then the other side to catch up. Predicting the course. What should you do next? Tracking the progress. How well are you building this business? Now, by us scoring clients over time, we're able to calibrate the velocity of traction. How quickly are they hitting these critical operational milestones? And again, to use a business building metaphor, if you had a time series of photographs of two contractors building similar buildings and one building went up faster than the other one, you could say that their construction team was better, right? Because the velocity of building that building, right? C.C. Myers is a very famous builder out in California. I don't know where he's at now, but he was known. He was the one that rebuilt the Bay Bridge after the 89 earthquake. He would go in and underbid everybody else, but he would always have performance incentives if he can shorten this cycle time and come in under budget. And he would make so much damn money because he would always underbid it because he knew he could build things faster. And when you're building, like trying to rebuild a bridge or an overpass or things like that, that's really important. Speed of rebuilding infrastructures, same thing, right? So we actually track our clients. So I can tell you which of our clients are our best management because of the velocity of traction measured against the Bell-Mason Diagnostic. How quickly they hit critical milestones to build a business. Okay, and then for the entrepreneurs, it allows them to focus. What is the right thing today? What should be working on today? Because it's the most relevant, highest value milestone. Don't keep working on product features because that's fun, sexy. That's where you misalign product market fit. You spend too much time and hit too many of the product milestones well before you get market feedback. And then you spend money and time building the wrong features as a result because you didn't listen to the marketplace, right? So this goes through, he also, again, it's rules-based, talks about Coopers and Lybrand, who's licensed this in the past. This has been used a long time, just by people that actually want to be more rigorous in their process. Now think about that, and then you watch most VCs run around and claim that they know what a good deal looks like, and there is absolutely zero process to what defines their enthusiasm from one company versus the next, aside from largely social signals. Who else is in the deal, right? It's the antithesis of process. They care about the optics. I manage money, and I, in fact, forced myself not to know who the company was because I just want to look at data to define which public company was worthy of entering our clients' portfolios. Okay.
Joe,
and again,
I have a question.
Yes.
Joe, I have a question for you. What is the difference between doing something faster versus cutting corners, and how do you account for that? Because let's say someone does something faster because, let's say, they know better, but if you're looking at this without, let's say, industry expertise, how can you tell that someone is just, they've built the better mousetrap, or they're just, you know, they're just skipping critical steps?
Well, and again, that's a really important question, and ultimately, that's what this construct allows you to say. Look, you're hitting a lot of milestones on product development because you want to move fast and break things. You know, the blitz scaling sort of model, right? But the Bell-Mason provides a construct to say, but yeah, to leave the alpha stage, you have to have unit economics that are profitable and sustainable. All right.
Mm-hmm.
Now, how many companies have gone public with negative unit economics? DoorDash, Uber. It has nothing to do with their funding round. They're literally using venture dollars, this easy, low cost of capital venture money, to buy customers, the freemium model, if you will. Those have negative unit economics. So that's one of the metrics within the Bell-Mason. Say, look, you don't get to leave the alpha stage until you have actually unit economics that are actually profitable and sustainable. That's one answer. There's multiple ones depending on what they might have moved too quickly on, but that's just one example.
Well, I mean, as I just put in my put in the chat, most investors are lemmings, and they don't really think through stuff this way. And the challenge becomes, how do you do the fundamentals? The other challenge it becomes as well, which sort of ties in, is that, you know, what happens if there's the concern that you're going to miss the window of opportunity here, to use another old cliche there, where, you know, for example, I'm doing some work with a company which is using blockchain and AI for resource management and sustainability. And the problem is that for all the ESG stuff that's going on, is that it's sort of faddish, and these guys are, you know, because part of it is that they can't get, you know, away from themselves. They keep, you know, stumbling over themselves for a variety of reasons. But the thing is, they're missing the window there. So that's sort of the pressure of trying to move faster as well.
Well, all those are absolutely accurate and relevant points on the existing state of how we fund innovation. Or shall I say the historical motivations from the investor side of how we funded innovation. And when investors say, you got to move fast, the blitz scaling, you got to blah, 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 right? Then entrepreneurs will respond because they need the money. But what that perverse motivation from the investment community has done is actually created a lot of bad practices at the entrepreneurial level. Because that's what this uninformed investment community largely is incentivized to do, because they themselves largely are lemmings, to your point. You know, the venture
And, you know-
industry itself is the last financial services industry where the principals, the GPs of venture funds, I'm not even talking about angel groups. That's all. Those are hobbyist investors. Those are, I don't want to talk about angel groups. I'm talking about the venture industry that gets paid and has fiduciary responsibility and discretion over investing their venture fund LPs money into startups based on whatever thesis they sold those LPs. They have a responsibility but they are lemmings because it's an industry that has no formal training, no licensing, no accreditation, no continuing education. They don't know what they're doing. They're lemmings because they literally don't know what they're doing because they've never had to know what they're doing. The National Venture Capital Association has never established professional standards or body of knowledge that would include the Bell-Mason Diagnostic or this QSBS tax law that Bonnie and Eric knows I've rattled on for hours about. These are critical components of de-risking your venture activity. But the venture industry itself is not a profession. And it's subject to all the things you just described and all those behaviors, which obviously bleeds down to what entrepreneur, how many times entrepreneurs say how to pitch a VC? Well, oftentimes you're literally being trained and told how to pitch somebody that doesn't know what they're doing, which is why we have the silly outcomes that we do. Now, I'm not saying the venture industry is unique in this. There's a lot of stupid investing goes on the public markets. There is a lot of stupid, but people have the ability to vote with their feet. They can sell a mutual fund that's stupid or was a FOMO mutual fund. Kathy Wood is the latest one, her ARC funds. But back in the 90s, it was the Janus funds. Same thing, momentum trade. It works until it doesn't. It's high risk, high reward. But generally speaking, the only people that make money are the people managing money with that FOMO sort of model. Because it's a very short-term, episodic window of opportunity to make money, but think of it as gambling, not investing. This is, the Bell-Mason is about bringing process rigor to manage risks. So you can actually invest properly, not gamble. Yep. I don't know if I'm answering that well enough because you make a very important point, and this is what I've seen now for 25 years, because the behavior I see today is exactly what I saw 20 years ago. Bonnie, I'll tell you the same thing.
Joe, you answered the question exactly right. I think it's always been absurd that someone who has a 15% hit rate is considered an investment deity.
Thank you. How fundamentally flawed is that logic, yet they've been able to sell that? Well, this is really hard and it's about a power law, so we got to swing for the fence. No, it's not that hard if you actually knew what you were doing.
Yeah. And singles and doubles are more important than home runs, but that's another conversation for another day.
Well, and equally as important, if you do the actual math, the beauty of this venture and in startup asset class is if you manage your downside. It's one of the unique assets where you have your downside is capped and you have no upside cap. You have asymmetric upside, meaning you can only lose 100% of your money. That sounds silly, but it's true. Yeah. But you can make multiples on it. So the logic says minimize your downside, because the asymmetry on the upside will take care of itself. As long as you don't go down as much, you don't have to go up as much. You won't need a unicorn if you avoid your losses. Risk management.
Yeah, I'm sorry if I just got you distracted off the rest of your conversation. No. It was just a point that was brought up, and I apologize to everyone else in the room about that.
It's really critical. This is the narrative. This is what I've been working on off and on for over 20 years, is to bring this mindset you're talking about, Andy, to call bullshit on the venture industry. And I've been screaming at the top of my lungs for over 20 years. Well, off and on. When Angel Legacy closed in 2003 until 14. So there's a 11-year gap there. But at its core, the model itself is flawed. And finally, with Sequoia and Andreessen and General Atlantic and now Bessemer, and I'm telling you, the floodgates open. Hell, even PitchBook talked about this in their year-end report or January 2021. Look back, look forward to the venture industry. They said the venture model needs to change. And it is changing. So thankfully, the change is evidence even from these big names, but the directional change is in the direction that is going to be far healthier for both the LPs and also the entrepreneurs, because we're going to get off this silly process that we're currently at the current state of affairs. So again, this deck is really valuable, but here's some of the case studies. These are real companies that are really interesting. Scoring on where they're at. Ovation, founded in 82. They raised 6.8 million in 82. That's a pretty good number back then. The product was to be sold for $4.95. Next generation integrated software with word processing, spreadsheets, database management. Sound familiar? Target market, outcome, chapter 11, 2 years later. Having won the product of the year as vaporware. They never built the product. They were good at, the CEO was a sales guy. See, he would hit a lot of the marketing and sales, no product development. He was selling vaporware, and he was really good at raising money and selling vaporware. Another example. Analytica, a lot of product, very little marketing. So this is another product market fit out of balance. The first one is too much marketing, not enough product. This is exact opposite. 82, raised 8 million. Next generation microprocessor software, relational database, blah, blah, blah. Distressed acquisition by Borland 3 years later. Never got there. Right? So this sort of walks you through stimulating new companies, right? There is value in what are these factors that are important to manage risk. Okay. So again, I don't want to, I know this is about the Bell-Mason Diagnostic, but I don't want this to be real dry. You can read this on your own. And again, I want to open it up. I put my contact information. Anybody wants to do a real nerdish deep dive on this stuff or really understand how we do the scoring, what are the relevant, because there are relevant data points. Components of the Bell-Mason are more important than others at different stages of the startup lifecycle. So what's the right thing to focus on at the right time is always relevant. Just like when I manage money in the public markets. The issues of large cap companies or large cap core or deep value companies or go-go growth companies, the relevant data points and research insights are different for the flavor of the company and the stage of the business itself. Public companies are the same as private companies. Bell-Mason simply gives us a construct to understand what's relevant at that point, both for the entrepreneur to build on and focus on, but also from an investor perspective, what risks to manage if they fit your investment thesis and you want to put it in a portfolio approach. That's what's also lacking in the venture fund model is nobody wants to build a portfolio because they don't know how to. So they all swing for the fence. They all try and really dive deep on one company and convince themselves it's a sexy deal and it's going to be a unicorn and it's going to be 100, blah, blah, blah. Right? That's a flawed construct. So I actually, just to put a finer point to this, and then forgive me if this sounds egotistical, but it's really relevant, that in building out what we built out, I knew that clearly that we're trying to implement a systemic change to the venture model and how people view how to invest and fund innovation. Obviously, Bell-Mason was critical for our vision and strategy, but also to convince people in an industry that doesn't know what they're doing largely, and a public that has been drunk the Kool-Aid of the venture narrative, the power law and, you know, swing for the fence and this is really hard and blah, blah, blah. And these VCs are really special, right? They really have insight. I started writing white papers on the dissecting all the things we're talking about right now. Risk management, portfolio approach. What would be a better way if you look backwards and tested assumptions, blah, blah, blah. There's lots of research out there. I'm happy to share it with you. I think I've sent it to Bonnie. She can share with all of you. But I ended up writing a white paper in Institutional Investors Journal of Private Equity in 2018. I didn't ever think I could ever get published in that, but I just serendipitously met the editor who lives in Ohio. He was in Austin. His son's an investment banker, and through connections, we had lunch, told him what we're working on. I said, you ever thought about writing for II? And I went, I ain't that smart. Those are for PhD smart people. I mean, I read II in college. It is the Harvard Business Review or New England Journal of Medicine for institutional investing best practices. And they have journals covering various disciplines of institutional investing, private equity, portfolio management, Journal of Commodities, Journal of Risk Management, Journal of Real Estate, blah, blah, blah. Anyway, long story short, private equity covers late stage and early stage private equity, venture and late stage PE. Got published. It was such a hit. He invited me to write a second one. It was the featured article. This is the summer of 2018. Then I wrote one in the fall of 18 and then a spring of 19. 4 times I've been published in II on what we're talking about here. Well, a couple of weeks ago, the editor of the Journal of Portfolio Management, who's a famous academic named Frank Fabozzi. Some of you that are finance nerds, you'll recognize the name. He's co-authored books with 2 different Nobel Prize winners in economics. He is right there at that academic level. He's been the editor of the Journal of Portfolio Management since 1986. He sent me an email. Said, Joe, I saw your Journal of Private Equity article and our upcoming September edition of Journal of Portfolio Management focused on private equity. And I'd love you to submit. We got one more article I'd love you to submit. And I sent him an email back, said, Mr. Fabosi, it's an honor. I've studied from your books in the past. But which article? I've had 4 of them published. He didn't, he only saw one of them. And after he saw and read all of those and some of my other social media posts, LinkedIn and Medium and stuff, he said, Joe, you're clearly an expert in this field. Write whatever you want. And it's been written, edited, and it's getting published. And it's called Process Alpha, How to Construct and Manage Optimized Venture Portfolios. Ta-da! Everything we're talking about is incorporated in this white paper. How to manage risk properly, how to use data to manage risk, to optimize on your decision model. There's a whole world of behavioral economics and behavioral finance that defines what's the construct of an optimal decision-making process, whether it's investing or other aspects of life. Daniel Kahneman won the Nobel Prize in Economics in 2002 on this very subject as a psychologist, because he is sort of the patron. So he's the inventor of what's called Moneyball, if we're all familiar with Moneyball, right?
Oh, yeah.
That's his work. Well, Daniel Kahneman is also on the advisory board of the Journal of Portfolio Management. I can't wait once this gets published to actually have a conversation. He's one of my heroes. But he talks about the optimized decision-making model, investing or otherwise. And that also is incorporated in the very white paper and the construct of what we built at AngelSpan and the legacy funds, which is the infrastructure to use the data I just showed you to actually manage and optimize venture strategy. We literally build a platform we license for free to family offices and VCs that actually want to do it better. And then we have some economics where we get a little piece of the carry if it's a GP driven, carried interest type venture fund. Family offices, we license it for free and help them use the platform just to invest better, so we can mobilize more money better for more startups. So that's I know we're going long, but I want to connect all these dots of, who the hell how do we get to this point? What is the Bell-Mason? But most importantly, why it's so important if we're going to actually improve how we fund innovation. Why it's so critical, because you have to start with good information come from the startups. And information theory, if you study it, you think of signal to noise ratio. There's a lot of noise in what comes from startups, demo days and pitch decks and all this sort of fluffy stuff. That's all noise in the system. But absent good information, what else does anybody have to rely on? So that's unfortunately what we've been using forever. And we have this chronic inefficiency, chronic biases, chronic underfunding in certain regions or entrepreneurial profiles or business model profiles, while the FOMO money just chases what was hot 6 to 12 months, last 6 to 12 months. How do we fix that? It starts with good information, and information itself is more signal than noise. And it has to be standardized, and it has to be viewed over longitudinal periods, because change in data is where the investment insights come from. Not from a fancy pitch deck and a really good pitch on demo day. Right? Longitudinal analysis is critical, but you have to have standardized information, not data. Look at, if everybody's seen a Bloomberg terminal, there's more data in Bloomberg than any other single point. And yet, how do you use all that information? Kahneman will tell you simple algorithms beat complex ones. You only need 4 data points as long as you know what the right 4 are. And that's the magic, is understanding what the right 4 are. And at a startup, it's different 4 data points at different life cycle stages. But it has to be data. It can't be fluff. And that data has to be comparable over time, across companies over time, and across different companies. So you can literally do an apples to apples comparison of the same company over time, but also company to company analysis. That's just basic investment theory. But guess what? Most VCs don't even know what they're doing. So this is what it's coming. There's a great report called The Future of Venture Capital, by the way. It was a study commissioned by a deep pocket, either a sovereign wealth fund or big family in Singapore. They hired Clayton Christensen's consulting firm, Mr. Disruptive Innovation. His consulting firm is called Innosight. They were hired and the report came out in 2021 and it's called The Future of Venture Capital. And it talks about everything I'm talking about. So these are unassailable truths. It's not my opinion, folks. These are unassailable truths. We're now seeing data points on this with Benchmark or Bessemer and Sequoia and this. But the fact is, it's not hard to understand it if you actually have a modicum of investment experience to look at how we fund innovation and go, this is just silly. And it is. But it's become too important. We can't go through another bubble. We can't go train another crop of new VCs after we get on the backside of this bubble that's just going to rinse and repeat the old bad behavior from the 90s and then the 2010s. We've got to, and it's happening now finally. That's the good news. We're seeing the model change. It's moving towards a more professional model, a more process-oriented model. And to get off this hot deal, flashy object, I know what a good deal looks like mentality. And thankfully it's coming. So,
Joe, I had one more question. How does the model deal with external factors? You know, interest rates, for example.
That is the most relevant question. Thank you. The number one, I'm speaking as an investor. If you study what are the defining factors of entrepreneurial success, the number one thing is timing. Externalities have an outsized impact. All this Bell-Mason stuff is even less relevant than timing. So from an investor's perspective, how do you manage timing risk? Anybody, raise your hand. Wait for it. Y'all know what it is. Matthew, what is it?
For me specifically with timing, I mean, I just kind of wait the markets out, and I guess when
mute. No, I don't want your opinion. No, this is portfolio management 101, folks. It's called, wait for it, dollar cost averaging.
Okay, dollar cost, of course.
So it's not prayer. So it's not prayer, Joe.
It's the simple structural tactic to manage timing risk.
My apologies, Joe. I thought you meant if you're getting it once, what are you doing? That's what I thought you meant. I didn't think you meant over time. Of course, dollar cost averaging, obviously.
Right. Yeah. So if that's the number one determining factor of entrepreneurial success or failure, then the best way to manage that is to invest in multiple rounds. Yes, you're going to pay up, hopefully, because that means the company's hitting milestones and getting traction. That's the good news. That's how you manage timing risk. That's called systematic risk, by the way, or market risk, or thesis risk. Now, the other risk is called non-systematic risk, transaction risk, and more due diligence doesn't improve outcomes. Only through diversification, period, full stop. Very smart investors say the only free lunch in investing is diversification. And yet, what does the venture industry do? They concentrate because they're the smartest guys in the room. So when you unpack the managing of, and your point is absolutely critical. From an investor standpoint, you have to manage that. From an entrepreneur standpoint, how do you manage timing risk? Well, you watch your burn rate. You make sure you're around a long time so you can optimize on where timing becomes favorable to your vision. Look at me. Look at Angel. 22 years I've been working on this. My timing was terrible 20 years ago. And 9/11, an exogenous event, right? You can't control those things. So as an entrepreneur, you have to be resilient enough, manage your burn rate, manage all those operational things to make sure you're around a long time. Now that runs counter to this blitz scaling, raise a lot of money and spend it quick and buy market share. But that's the bad behavior that's been incentivized by the VCs that fund that behavior because they don't know what they're doing. They're gambling with somebody else's money. So they're giving this gambling money proceeds to entrepreneurs that are willing to gamble with it. And they call that venture investing.
But that behavior is a function of near zero interest rates. Right?
There's a whole myriad of factors. That's exactly right. There's a whole myriad of factors. Numbers, by the way, numbers 1 is timing, 40+% determining factor. Number 2 is product market fit. Number 3 is execution broadly defined. And number 4 is funding. Those are and this is Bill Gross from Idea Labs, but it's been verified by a variety of other folks as well. If you look at Bill Gross, I mean, this guy's a Caltech. He's a brilliant brain. He's like Gordon Bell. He's a scientist first. So his conclusions are far more relevant than other folks to me. There's a lot of other people that have, this is why they fail. I go, yeah, well, how's that compare to Bill Gross? And how rigorous was your analysis versus Bill Gross's? Let's start there. before I listen to your conclusions.
Would you repeat those 4 points? I missed one. Timing, product market fit.
Yeah, timing.
And what
Product
was the
market
third one?
fit.
'Cause- Yeah.
Bill Gross did a TED talk on this from 2015. It's wonderful. So you go look at Bill Gross Idea Labs and it'll Bill Gross TED talk, and you can see him lay all this out in the science and the examples and everything else. It's wonderful. Timing, product market fit, execution more broadly defined, and then funding.
Thank you.
So, yeah, I'm not the smartest guy in the room, but I'm pretty compulsive about finding really smart people like Gordon Bell and Bill Gross and all these other folks to say, look, there's a better way to solve these problems, but you have to acknowledge you have a problem to begin with. And finally, the venture industries acknowledge they got a problem. Now, this is going to have massive ripple effects, folks, because how many angel groups are all trying to emulate VCs? They're VC wannabes, but they're wanting to pursue a flawed model. Or the accelerator model. So much of the curriculum of accelerators is useless because they came up with their own curriculum because they care more about their brand and the sponsoring dollars they can get for demo day. That's their economic model. Follow the money. They're all competing on their own brand and their special sauce. Oops. That's their agenda. That doesn't mean it's right. It's just what they're able to spew forth because there is no professionalism in the venture world. So there's nobody out there except a few of us to call bullshit on and have the facts to back it up. So this is the good news is it's gonna be painful for a whole lot of folks because there's a lot of people in this infrastructure of that old model, and that model is getting disrupted. And all of a sudden, all those ancillary folks that have been trying to scale that old venture model in more communities or more diverse, more profiled entrepreneurs, whatever, they got to change their curriculum. They got to change their thinking and thus how they're helping entrepreneurs. Because again, so much of that training is about pitching, about the limbic brain. If you go to Danny Kahneman, System 1 thinking is limbic brain thinking. It's what all advertisers know they want to manipulate so they can sell you something. All right. System 2 thinking is critical thinking. That's where you manage risk well because you're not caught up in your limbic brain that's where FOMO resides. Fear of missing out. Want to be one of the cool kids club, right? That's all limbic thinking. Anyway, I know I'm blathering on and on. I go on for hours, as you can tell. But I have reams and reams of stuff. I know, Bonnie, I don't know if you're recording the chat box. I hope you are, because I'm happy to respond to some of those requests. I've got this white paper in its crude form. The copyright says that I've signed says that I can't send you this, but I can send you sort of the raw material that ultimately has been edited into this form. And it's not the same body of work, but it's the same conclusions, folks.
Joe, when is that white paper going to be released?
It's in their September edition. So the next,
okay.
These
So
are quarterly
September.
publications. Yeah, these are quarterly publications.
Okay. So we just got to wait a couple months. Not that big of a deal.
Yeah,
but I get what you're saying. You can still do the raw background research yourself if you wanted to. Yeah, which is great. Great.
So I'll avail anything. I've got well, hell, I'll just put it in the chat box because this is the research that fueled that. I just wrote a narrative around this research. I'm going to send you a link to this compilation. I've been compiling research from every smart people I could find, Monte Carlo simulation, studying what's optimal diversification, who did that work, and what are the conclusions. So this is all sort of stuff I've been compiling off and on for over 20 years.
Love it. Wow.
And so I will I've just put it in a one piece with links to all this external let's see here. Optimize. Where is it? Oh, Jesus Christ. There it goes. No, what the hell's going on here? Oh, there we go. So this is a link to a lot of work that others have done. My 4 white papers are at the very bottom. You'll see at the very bottom is institutional investors, Journal of Private Equity. There's links to all 4. It's the watermarks of those 4. That's 4 years ago, so they're not going to chase me down.
Are you going to post in the, oh, there it is. Yay.
Yeah. So no, there's a lot of work in there. And that future venture capital report is the very first thing in here. So start there. I put these in order intentionally, because once you understand the premise that is captured in the future venture capital report, then everything else is subsets to support their conclusions by this quality research done by very smart people. My work and what we're even doing is the very, very bottom. So if you make it that far and you've internalized the conclusions from all these really smart people, then what we've built will go, well, of course, because that's what all the research says you should do. That's why my stuff's at the bottom. Okay. So the shameless plug for what we're doing, if you care about entrepreneurs, send them to AngelSpan, period. If they're 3 months from their first funding rounds or anywhere up to their B round, we will make them better. We'll accelerate their funding cycles. We'll make their existing relationships with their current investors better. We'll help them attract attention to a more sophisticated investor. We've got page after page of testimonials to validate everything I'm telling you. So that is, if you work with entrepreneurs and you're helping them succeed, send them to us, because we're an arrow in your quiver. We'll make you look good in their eyes. We're not expensive. We're not charging entrepreneurs a lot to do what we do. That's not our key economic model. We need the data to score against the Bell-Mason. And that's a human, we put a body on every client. This is not do it yourself. They don't upload stuff. We take very little of the CEO's time. Eric had to leave, but I gave him some room to tell you the actual impact.
Wait, Joe, can I interject for a sec?
Yes, sir.
Can you give us just basic parameters of what you're looking for when you say send us an entrepreneur? That's a pretty broad statement.
Yeah, it's a startup that has, if you're working with them, I suspect that, and they're paying you something, I suspect they fit.
Okay.
All right.
Okay.
The wannabe entrepreneur, the new kid,
yeah,
you know, the FOMO entrepreneur.
The guy with just an idea, no good.
Or
guy with money, guy with active capital, guy with something beyond it. That could be something.
If they've got a man bun and they're too cool by half, I'm not interested. I'm serious. That's a tell, folks. They care about their own brand. Yeah. It's about me. They're good at getting money out of the demo day crowd.
Yeah.
Because that demo day crowd is a limbic crowd.
Yeah.
Right? No. Guys like Erica get us like that. Serial entrepreneurs get us like that. They know what this communication is critical. And it's hard to get right. We simply built the first solution to get it right and outsource it to a professional firm. Exactly. And all of our competitors out there are all just templates, a library of templates, and it's all do it yourself.
And just to get a
structure, we do the writing, we do the scoring, we coach them on making sure you're not, we don't tell them the Bell-Mason Diagnostics, but there's a little bit of subtle directional nudging.
Yeah.
Richard Thaler, another Nobel Prize winner, we nudge.
And just for a little more clarification, tech agnostic, any sort of tech. Yeah, no big deal. Okay.
I want C Corps, LLCs is also an interesting tell.
Sure.
They got bad advice to be an LLC. So there's some real filters here. So it's not hard to filter out who you don't want to do business with and or invest in. If you understand what are the right tells.
There's so many that come to mind. Okay, great. Joe, thank you so much. Yeah.
Yeah. And again, where we know we have the biggest impact, and they should use us 3 months before they're trying to raise the first money from strangers. I hate labels of pre-seed, seed. That's all bullshit. You got friends and family and bootstrap friends and family, and then you spent that money well enough. You think you got something to go pitch a stranger. They need to hire us 3 months before they start that process. Because having the longitudinal, we can do a snapshot, a balanced scorecard against the Bell-Mason to support their pitch deck. 3 monthly updates in a row they can send out so the potential investors can look backwards quickly. We truncate the due diligence process. We collapse it. We got testimonials from one meeting that they left the meeting with the potential investor, not asking for money. Can I put you on our stakeholder list? They go back. Our platform allows them to go back, send an email and said, thank you, Bob or Sally, for your time. I appreciate your interest in what we're doing. I've added you to the stakeholder list. And by the way, here's the last 3 monthly updates and a couple other things you might want to take a look at to catch up. We've got more than one. I quit counting. I'm going to say half a dozen, where literally that investor got the email the same day following the meeting they had earlier and said, my God, this is how you communicate. Will you take 200,000? Will you take my money? I'm not kidding you, because they've never been respected like this. When you're not pitching and you're treating them like an actual thoughtful investor, you've just de-risked it for them. They wouldn't have taken the meeting if they didn't like the concept. They wouldn't have taken the sit-down meeting if they didn't like the concept.
And Joe, is this like a service package, or is this something you take like just a piece of equity, or what
No.
combination?
Yeah,
or is it...
Look it. All right. I'll get Bonnie. Sorry, I'm going to put a little brochure in the if that's all right.
No, come on.
Yeah, please.
Please.
Yeah, please.
appreciate
We
it,
want to know.
sure.
We want to know. Yeah.
So it's also a replacement for a data room, no?
For what?
It's also a replacement for a data room, I would think.
Oh God, yeah. Well, let's put it this way. It sits on top. It makes sense of the data room.
Yeah. It organizes the data room. Yeah.
Yes. It becomes information.
Mm-hmm.
That's the point. It becomes data is one thing, but this becomes information and longitudinal information, which is where investment insights come from. Data, information, insights. Look at the information theory. There we go. That's a link to, and you can share this with anybody. This is just a quick brochure. It doesn't have testimonials or anything else. If anybody else wants a deeper dive, please let me know.
Definitely.
I'm not a very good sales guy. I don't want to be shameless and throwing too much at you. So if you're interested in the testimonials, if you're interested in the broader vision, I've got a simple deck that shows why AngelSpan and legacy funds work together. What do you do with data to build and construct venture strategies that can deliver alpha to your LPs? I don't care what your venture thesis is. We can do that.
Joe, I tell you right now, I definitely want a deeper dive. I'm telling you right now, 100%.
You got my email. Just send me a note, Matthew. That'd be great.
I definitely will. Thank you.
That's an hour and a half, and I got another call in 11 minutes. So,
I want to thank you so much. Unless there are any last words of wisdom or one last question, if you have time, I'll even know if you have time.
Go watch the Elvis movie. That's my best advice I can give you.
Okay, I will do that.
But watch the press conference at Cannes after it was shown at Cannes, where the director, the producers, and the actors are all there. Watch that before you go see it. It's on YouTube. They broke a record. They had a 12-minute standing ovation at Cannes. It never happened before. It's the record at Cannes by like an order of magnitude. The movie's a work of art. So watch that and then go watch the movie and you'll go, holy cow. I'm an Elvis fan. I'm a deep Elvis fan. And I learned stuff, but also I came away from that just moved. This actor that played Elvis is stunning. It affected Lisa Marie and Priscilla. They had to leave the room watching it because they felt Elvis was alive. This guy was so good. He did his own singing on about 70% of the songs, and he'd never sung in public either. No voice lessons. He was unbelievable. Now, and the directing, it's the same director that did Moulin Rouge and The Great Gatsby, Baz Luhrmann. I'd never heard of him. The guy's an artist. Guy is really something special.
I heard he actually hurt himself when he was doing all those movements. He actually hurt, I think it was his shoulder or something.
I don't doubt it.
He had to do physiotherapy.
Yeah, I don't doubt it. No, it's really special movie. That's my best advice, closing advice I can give you.
Yes.
Oh, fun. Thank you.
Yes. Yeah. Baz Luhrmann is, Moulin Rouge and the stuff he did like a Romeo and Juliet. I mean, he's just been over the top. But, and I'm going to close with one of my mother's favorite jokes, which was Elvis the Pelvis had a twin brother, which very few people know about.
Yes.
His name was Enos. You can guess his nickname. Anyway.
Yes, but his brother died very young.
Jesse died at birth. Yeah, I mean, Jesse was his true twin. But there was Enos, which very few people know about. So
yeah, it's tragic. Yeah, little known fact, right? I'll give you a little bit of Elvis trivia. I learned at my 40th birthday, which was a surprise Elvis themed 40th birthday party. My mom dressed up as Elvis's mom. My wife dressed up as and we had an Elvis impersonator sing at dinner. It's the first time I ever sang in public was with the Elvis impersonator in front of a room of 40 or 50 friends and business associates. And I sang American Trilogy. And my family's jaw dropped. My colleagues, they had no idea I could actually sing.
I've even heard of that song.
But it's brilliant. Watch the live version, American Trilogy, live via Hawaii. It'll give you chills. I got a Elvis trivia book from my father-in-law. And I'm flipping through this thing, coffee table book. It's this thick and, big fancy thing. And I'm flipping through there and it says, the first time Elvis sang in public in front of a crowd was at his 6th grade talent contest. And he went to Milam Junior High School in Tupelo, Mississippi. That's named after an ancestor of mine. No shit.
Oh,
I
wow.
had no idea. You can look up on the internet, Milam Junior High School, Tupelo, Mississippi. You'll see Elvis's picture in his 6th grade class photo. He literally went to Milam Junior High School. Here in Texas, it's the same Milam that's my ancestor Ben Milam. That's the first hero and the first martyr of the Texas Revolution. Same Milam gene pool. So anyway.
So you were born with Texan in you and with Elvis.
Yeah, you know, it's just meant to be. So anyway, folks, thank you for letting me blather on. I appreciate, you can tell I don't take myself too serious. And it's a really important to contrast with the venture world. I don't take myself serious. I just take what I do extremely serious. And I'm a freaking nerd on research. I ain't the smartest guy in the room, but I'm compulsive about research. And everything I've done is always about just assimilating the smartest people I can find and assembling through what's called design thinking. The solutions that have been proven successful elsewhere apply to what you're trying to solve here. It's that simple. Don't think you invented something. That's just narcissism and arrogance, right? That's what we've done. If all this research is other people's work, my white papers are just a distillation and assimilation. AngelSpan has only invented one thing, and we didn't really invent it. It's a crude application of research that came out of a university in the UK. One of the things I'll send those of you that are interested, if you are an investor or advising investors to invest in startups, the single best due diligence criteria, I'm going to put this in the chat box. It's really critical. It's an article that came out, research done at the University of Leeds. And this came out, the research was published in TechCrunch back in, I think, 2020. So I'm going to give you the TechCrunch article, but the conclusion is what's critical. And the headline reads, come on. Study associates frequency and quality of monthly reports with startup success.
Huh.
The research shows, think of Elizabeth Holmes. The absence of transparency is risk. The presence of proper transparency is de-risking. It's the most important de-risking step. Period. That's why AngelSpan is so critical if you care about startups and the investors that you're trying to help invest in startups well. You start with proper transparency.
Yep.
That is your first due diligence criteria. That also gets you out of your limbic brain. Okay, folks, I got my next call coming up in 5 minutes. I'm getting nudged on it. So
okay, I'm gonna invite you back in September after your white paper.
Oh, it'd be good fun, folks.
Okay,
yeah,
you,
and like I said,
everybody.
folks, I'm an open book. I give all this research away. I'm trying to change the system, and I can only do it when people want to change themselves and be agents of change. So if you want to fix how we fund innovation, just reach out to me and I'll give you everything I got. All right.
Thank you.
Thank you.
Thanks.
Thanks, Joe.
Enjoy
Thanks,
it, folks.
everyone.
Thanks, Bonnie.
Have a good day.
Thank you. Thank you, everybody.
Bye-bye.
We'll be back in 2 weeks with our next breakfast, and it'll be posted in the newsletter, and you will post it as well. And thank you, Christine, as always, and have a great day, everybody.
Thank you.
Bye, everyone.
See.
Bye, everyone.